Hello everyone, I'm Akshra Menon from PMS Bazaar. I'm delighted to welcome you to today's Friday webinar on the topic that has become increasingly relevant. Are debt AIFs outshining equity in volatile markets, exploring the shift in investor preferences. With equity market facing pressure and searching for stability, and capital preservation is taking a center stage now. Investors are now actively diversifying across asset classes with growing preferences of debt products. Recognizing this shift, we at PMS Bazaar is bringing you this exclusive session on the private credit, as this asset class is rapidly gaining its traction. To talk on the private credit, to have more perspective, the overall 13 lakh crore AUM in AIFs, 10 lakh crore is being held in Cat 2 AIFs, almost 80% of it, which includes private credit, private equity, real estate, fund of funds, the distressed assets, and more. Among them, private credit in particular is witnessing a remarkable growth driven by the business seeking flexible financing beyond traditional banks and capital markets. According to the ENY latest report, which spoke about the private credit, stated that the private credit investments in India reached almost around 3.3 billion USD in the second half of 2024, bringing the annual total to USD 9.2 billion across 163 transactions. This is a 7% of growth from compared to 2023. These numbers reflect the growing prominence of private credit, the key investment avenue. But rather than just numbers, let's hear directly from the expert who has been the forefront of this transformation. We are privileged to have with us Mr. Amit Kansal, Head Alternative Investments from Aditya Birla. Hello, sir.
Yeah, good evening, Akshara.
To have a brief about him, with 22 plus years of experience spanning across Aditya Birla, Capital, ICICI, and ENY, Amit has played a pivotal role in conceptualizing and leading the special situation and stressed asset platforms, including JV with Bud Partners and US-based credit fund. He has managed investments across credit spectrum, from a single-digit yield papers in large corporate groups to high-yield trades, delivering nearly 70% IRR in asset reconstruction scenarios. A commerce graduate from Sri Ram College of Commerce and a rank holder of Chartered Accountant, Amit brings unparalleled expertise in alternative fixed income. This will be an interactive session, so feel free to drop your questions on the chat box. So we'll take them during the discussion of this webinar. So let's get started. Thank you for accepting this, sir.
Yeah, my pleasure.
So let me take the first question for today. As the topic suggests, which states that the investor preference is moving from equity to debt AIFs. So how do you see this shift moving in this volatile market?
Sure. Good evening, everyone. And thanks for setting the context, Akshara. I think that's a very pertinent question for the day. So I think what Mr. Trump has done, he has upended the world economics as we knew before he came in. Though he's in his second term, but I think this time around he has been more vocal and very vociferous about what he believes in and what he wants to do. I think so. I think his preferences are very clear, which are, I think, deviating from the policies of Mr. Joe Biden. So basically, what he has done is he has upended the global world trade as we know it. So with the increasing protectionist agenda that Mr. Trump has, it has led to an increase in uncertainty. So the world over, the markets are roiling. There's a lot of upheaval in the world markets. So what then uncertainty does is leads to a rise in volatility, as you said. And once there is a rise in uncertainty, which leads to a rise in volatility, investors look for safety, right? And if you again look at where investors could seek safe passage, they will try and hide there. So the first and foremost, from a developed world perspective, the money flows from emerging markets to developed economies, right? So you see a lot of FIA outflows. That is one this thing, because for FIA it's their home market, they are familiar. It's a developed world this thing. So once the returns become attractive or they see that the growth is moving, so when the money starts moving there. Secondly, from a very macro perspective, if you look at dollar is a safe haven as compared to, there's a currency risk also. Like if you look at the way INR has behaved vis-a-vis dollar, so there's a currency risk also. So in times of uncertainty, people try and seek, safety behind dollar assets. That also accentuates the shift to developed market. Another option one could, one looks for in these times of scenarios is bullion, like gold. Also, if you look at gold has also rallied significantly, right? Basically, it's a hedge against uncertainty, hedge against inflation. And obviously, last but not the least, the topic for today, it also leads to people to reassess their allocations towards debt, because ultimately debt is, a risk averse product. It's a risk off product. So now that, with the increase in volatility, people are moving away from risk on products. They look for risk off products, and debt clearly is a risk off product. It's a fixed income product. It's a regular income product. So that's why, with the increase in uncertainty leading to a heightened volatility in the global markets, we are seeing this renewed interest. Basically, it's nothing but, if you look at a course correction from an investor point of view, the portfolios which had become much more lopsided towards equity are now getting rebalanced, and debt is finding its rightful due. That's the way I would look at this changing scenario.
Yes, sir. But in equity markets, this is not the first time we're seeing this low phase. We have seen it before. Like it can be a COVID time, or it can be Ukraine-Russia war, or we had elections in between. All these times, markets was under pressure, and we want to understand during these times how did the private credit space it performed, and how did you how are you able to balance it?
So there are two or three, criteria on which one can evaluate there. Okay. One is the drawdown, right? Equity, basically drawdown, I mean, like when you invest 100 rupees in equity, it can become 90 rupees or even 80 rupees. Eventually, it may become 100, 120 rupees, 150 rupees. That's a different question. But there is always a possibility that the principal also may erode. So anybody who's looking for an exit at that point of time, and again, future is not a guarantee of a past performance, as they say. So at any given point of time, you may be, at a risk of losing your principal. So if you look at on that touchstone, in the period of Ukraine war, in the time of COVID, in all the period of uncertainty in the last 10 years, okay, there has not been a drawdown on the private credit side, whereas equities had led to a heavy drawdown. Second is volatility. If you look at, again, volatility, just to simplify, means that, are you delivering those returns consistently? Or again, there could be a scenario where, let's say for 2 years, 3 years, you deliver phenomenal returns of 25% per annum, 30% per annum, and then again 2 years you deliver, let's say, let's not talk about negative, let's say you deliver zero return or 2% return, thereby averaging it out, right? Again, on that count, if you look at, private credit has been much more consistent. Globally, if you look at, private credit as an asset class has given a return of 15 to 17% over the last decade or two, consistently, continuously, without any drawdown. Even in COVID period, when the equity as an asset class, the kind of mayhem it went through, the drawdown was hardly any in private credit. As against that, if you compare equities, which is the kind of, because of the excitement probably that gives to people. And obviously, again, I'm not comparing two asset classes. Equity has its own charm, equity has its own appeal. Equity also, actually, if you look at in the Indian context, and I'm not talking about the recent data, the last I checked was around a month back. Then also, the Nifty 10-year CAGR was close to 10%, even if you add a dividend yield of, let's say, 1 odd percent. So you are looking at a 11% kind of a CAGR returns from a Nifty. As compared to that, I'm saying, even if I take a very safe strategy like a performing credit, which can give you 13, 14, 15% return post expenses, I think there's a strong case. So that is the reason why you are seeing this renewed, traction towards it. Because again, private credit as an asset class, especially in the Indian context, was not that much, I would say, existent or that relevant or that much in scale and size. It was always existing in pockets, but it was probably a much more niche class. It was also dominated by, foreign players. Now in the last 3 4 years, a lot of Indian players have also kind of come on the scene. As you mentioned about the EY data, again, if you look at that report also talks about, for the first time in the last so many years, not only has domestic funds overtaken foreign funds in terms of deal count, even in terms of value, we have overtaken foreign funds. So now obviously, as the asset class grows in size, it is, and again, there's a relevant time for you to an investor to assess. I think it's finding its rightful due.
Yeah, I agree with your point, saying that it is not a peer-to-peer comparison or apple-to-apple comparison when I'm going to compare private equity and the equity markets out there, of course. But the traction that we have today in the private equity market or in a debt side market, if you ask me if the same interest was there in 10 years ago, it wasn't the same. But so how do you have been in the industry for so long? So how have the investors preferences have changed in last decade towards private credit?
So there are 2, 3 points again I would like to make there. See, one, if you look at globally, private credit came to the center stage post the global financial crisis of 2008, right? When there was tighter regulation in terms of risk weightage and banks vacated the space, and there were issues at financial institution. So obviously there was a void that these things left, right? And so therefore players in the private credit stepped in to fill that void. In the Indian context, I think things were comparatively hunky dory. I think till 2018, I would say the corresponding moment in Indian context came in 2018 when your ILNFS crisis happened, your Yes Bank crisis happened, your DHFL crisis happened. So one, I think just in terms of, I would say, developmental timeline, we were, let's say, kind of a decade behind, or we were, you can say we had an additional decade of good run where NBFCs, credit risk MFs as a category were kind of, and again, a few large banks continue to operate in that category. It is again, now in Indian context, if you look at 2018, some of the things that happened in the global context post 2008, in terms of higher risk weight, in terms of investor preferences towards retail. If you look at now, there's a trend towards retailization of NBFCs, right? If you
Mm.
any NBFC that is kind of listed or is kind of looking for a valuation, which obviously that is a good measure of shareholder value creation, right? So one should look at that kind of a value metrics. So if you look at retail is what commands the premium, wholesale is no longer the kind of the name of the game. So I think it is because of that trend that you look at that there has been again a vacuum in the Indian market. So that one has led to demand. And once obviously there is demand, there is supply. But again, that is not the only factor. I think if you look at simultaneously or in the parallel, a lot of developments or a lot of work has been done by the regulators and legislators. If you look at Insolvency and Bankruptcy Code, again, I think that was a very big missing piece in the Indian scheme of things, right? If you look at the way our recovery efforts have been, again, there has been a SURFACE, there is DRT and stuff like that. But again, in terms of the timelines, the delay, in terms of recovery values, the impediments, the kind of litigations one went through, these are pretty long drawn processes. It took years and years on end. IBC came and changed the entire paradigm, from a debtor in control to creditor in control. Now the promoters are afraid to lose their companies. So in fact, there is a lot of big deterrent effect also. So it's not only that IBC has worked wonders, but I would say IBC has worked wonders for the assets which are already delinquent at that point of time, right? Which assets which had already gone down under. But I think the success of IBC can also be marked by the fact that out of the cases that were filed for admission, how many were withdrawn, how
Mm.
many were settled. So in that sense, I would say IBC is acting as a big deterrent. So that has also acted as a big enabler of the ecosystem. And again, if you look at the third catalyst is post 2018. Again, 2018 globally was not a watershed event, while in Indian context it was. So globally, the firms which are already active, in the private credit space, they came and they started kind of deploying. Like our partnership with Varde also kind of happened in 2018. They came and started deploying money in India in 2018. Then Indian fund managers also kind of came to the age. So it's a function of demand, supply, and enabled regulatory framework, and I think that's what has put the spotlight on this asset class, and that's why it's growing leaps and bounds.
Yeah, we talk about the spotlight of the asset class as such. There's one question from the audience which says that, can you specify the size of the private credit industry in India and globally? And also, let me add on one more question. So, where do you see the gap? Because private credit and globally is being well more, regularized and well more common. But in India, it is not that common. So, how do you see the gap?
So gap is huge. I think it's there's no comparison. So if you look at globally, it's already grown to $2.5 trillion, and in India we are talking about 15 to 20 billion dollars. So we are nowhere there. So and again, if you look at the way we are, right, we are already one of the largest economies of the world. So even in terms of, if you look at our share of world GDP, we are long way off. So even if I were to say it was to triple or quadruple in the next few years, we'll still be not there. So I think in that sense, as I said, I think the way one has to look at it globally, see, any asset class, once it begins, it takes time to, take off, right? It's not a vertical takeoff. First, you will have a kind of a little more kissing the horizontal line, and then you start kind of taking off. And then obviously there's a period when it kind of, vertically just shoots through it. So in Indian context, if I look at 2018 when it started, then 2020 was the COVID year, 21, 22, a lot of serious interest started coming and you started seeing the growth. In fact, again, as per that EY report, when you mentioned, $9.2 billion was the 2024 deal data. 2021, it is only $3 billion. So while I think you mentioned a growth strategy, which look much more nimble and modest, if you look at a 3 or 4 year horizon, because sometimes, in fact, the same EY report also mentioned that is $9.2 billion is also because certain deals got spilled to the next year.
Yes.
So had those deals kind of concluded, and obviously I can talk about these are a couple of large deals which single trade is also worth $1 billion. And also if those deals would have been, kind of concluded, we are talking about 11 or $12 billion. So if you look at from a $3 billion in 2021 to 24, I'm saying let's take 9 billion also, we are talking about 3x growth.
Mm.
So in that sense, I think there's a lot of potential. As per our own estimates, we are looking at a market of at least $50 billion over the next 2 to 3 years.
Okay. So the opportunities are huge inside the private credit market.
That's right.
So when the opportunities are huge and even deals would increase, correct? So how should an AMC should approach one particular deal? Or I can make it more specific, saying that how Aditya Birlas are approaching a deal.
So let me answer it in two parts. Okay, let me complete the opportunity point first, because that also feeds into what kind of deals, and how does one look at it. The way we look at the opportunity, as per our internal estimates, this opportunity is worth around $100 billion over the next few years, say 5 to 7 years. Okay, we have divided this opportunity into three buckets. One is a growth bucket. Growth is anything which is going towards your asset creation, any money that goes towards productive assets. So that could be your last mile financing, your cost overrun financing, your holding company finance, your mesh debt kind of structures. Second opportunity we see is in the strategic capital. Strategic capital is anything which touches your capital table. So your acquisition finance, your buyout of private equity, your bridge finance, those are all examples of acquisition finance. Third is your opportunistic capital. So you have examples of sponsors finance, loan against shares, financing any cash flow mismatch, or simply there could be a situation where a company which was earlier with a special sits kind of a fund now wanting to come back to the banking, and in between it has to go through a performing credit. So we look at the opportunity across all these three scenarios. So I think the opportunity is fairly large, and again, opportunity is not uniform. So at some point of time, you would have growth capital dominating. Like at the stage where we are seeing much more action in the growth capital and strategic capital as compared to opportunistic, because the equity markets till now are pretty buoyant. So I think promoters raised a lot of equity money. So in that sense, I think the opportunity in comparatively opportunistic set is lower as compared to that. Obviously, India being a growing economy in a growth phase, we are seeing much more opportunities in growth capital. And similarly, strategic capital is also, you can say, an adjacency to growth capital, because as your action happens in more action happens in M&A, merger and acquisition, or there's more private equity investment happen, that leads into acquisition financing. So that's how the opportunity set is. As far as our philosophy is concerned,
The deals part, sir?
yeah, I'm coming to that. So as far as the deals part is concerned, see, again, we have four kind of pillars. 4 C's, what we call it. Character. So from our side, we look at the corporate governance standard very closely. We are very strict. We are very clear about that. Promoter pedigree, promoter background. We don't want to deal with promoters with a shady or those kind of checkered kind of history. Okay. Then we look at the capacity. So by capacity we mean we are not looking at over leveraged companies. We are kind of we want to deal with companies with the right kind of a cap structure. Some of the yardsticks we use are like debt to EBITDA, debt to equity, net cash accruals. Third for us is cash flows. Again, we are not in the business of taking recourse to asset or repossessing assets. So we want the cash flows to be able to comfortably service our debt. So in most of the situations, in fact, our deals don't run the full course. If you have done it right, so at least 40-50% of the time you tend to get prepaid. So we lay a lot of emphasis on cash flows. The refinancing assumption also, if it is built, is for comparatively for a smaller amount, right? It's not 100% kind of a refinancing. Fourth is collateral. Okay, we are also cognizant of the fact that things may always not go as per your plan, right? So there has to be a plan B, and that's where collateral comes, becomes important. So it is in that respect that we tend to gravitate towards, I would say, asset-heavy industries. So we like manufacturing, we like steel, cement, chemical, we like infrastructure, we like roads, power, ports. Again, infrastructure may not have the assets, so you cannot maybe let's say do anything with the road, but these are now concession agreements, sovereign risk, which has stood the test of time. This PPP framework has been around in the country for more than 20 odd years now and has, kind of pass through the various tests. So that's why we like, because in that case, basically, even if my assumption goes wrong, I know that I have some fallback. I can easily recover my money. And in that sense, again, if I look at, generally we are not doing any deal below security cover of 2.5 to 3x. And there again, I would like to draw your attention to an interesting statistic under IBC, which talks about that the recovery relative to fair value in IBC has been around 85%. So which means that if the fund manager has done his job properly and this 2.53x cover is actually there, is actually existing, then hypothetically, even if things were to go wrong, I would probably end up recovering 80-85% of the money, which is way more than the 1x. See, ultimately, it's a debt investment, right? So ultimately, what the borrower owes to you is principal plus interest, P plus I as we call it, right? So you are safely home. So that's what
True.
our philosophy is.
Yeah, very much true. And you were talking about the sectors inside private credit, like manufacturing or infrastructure, which is in the asset-heavy sectors. So among them, like among the sectors that you have mentioned, like chemical, manufacturing, or infrastructure for that matter, which sector is likely to grow inside private credit in next few years, or how do you foresee them?
So again, Akshara, I think one has, it's a more of a, I think I would nuanced question, and I would like to reply to it that in that way. See, because it's a matter of what kind of need you are catering to. See, ultimately, private credit fills a vacuum or a need which is not catered to by the normal banks and NBFCs, right?
Mm.
So I'm saying again, if I look at a growth capital, typically the sectors may be different. Growth capital you would tend to see in sectors which are undergoing capex.
Mm.
And again, here I would like to make an important point that as compared to the big bang capex of yesteryears, this time around we are seeing much more decentralized capex, right? So let's say we are seeing capex in chemicals, we are seeing capex in auto components, we are seeing some capex in steel, cement. So those are the kind of demands that will come there. When it comes to, let's say, something like a strategic capital and acquisition finance, we have seen a lot of deals, where consolidation is happening. We have seen in your pharma, we have seen some in your FMCG. So again, the sectors may be different depending on the use case. But having said that, our thesis is comparatively straightforward or clear that we would like to stick to, again, if I were to take another dimension, I would say we like comparatively traditional sectors better as compared to new age. This thing again, the thing with the new age or new economy, this thing is these are more services. This thing which are not asset heavy. So whereas you see kind of much more, the capital intensity is much more heavier in the traditional sectors of the economy. So that is one way to look at it.
And also, when you
Hotels,
were
we are seeing a lot of capex. I think we are also coming up with these newsletters on a monthly basis. You can look at my LinkedIn handle. So we have like hotels is something we are bullish on. Chemicals, specialty chemicals is something which we are seeing immediate basis capex.
So I could say that you're not sector specific, you're sector agnostic. Like, it is spread across most of the sectors.
That's
And
correct.
yeah, please. Sir.
No, no, please. I know I'm saying that's correct. That's correct.
Yeah. And moving forward, regarding the the credit worthiness, because always there's the default risk that comes along with the debt fund generally. So with that, how should an investor, from an investor perspective, how should they evaluate the credit worthiness of a potential investments, particularly if it is below a A-rated company?
So again, I think Akshara, I think we are talking two things here. One is how should an investor evaluate? Maybe that's more from a fund level perspective, and second is probably you when you talk of A and below, you are talking about our perspective. How as a fund manager we these things. So I'll probably answer it again in two parts. So let me start as a fund manager. How we look at credit rated below A and below, or for that matter, any credit for us, because again, rating is a third party labeling of a particular credit worthiness, it is not, it may or may not be in concurrence with our own assessment of the credit, right? So the way we look at it is, again, as I mentioned, there are 4 C's, but again, when it comes to purely credit worthiness from the perspective you are asking, A or below, it is the cash flows. First and foremost is the cash flows, right? We look at whether they have the capability to service our debt or not. So there we would look at some of the metrics where we use debt to equity. So generally we would not like to go above 2:1. We look at debt to EBITDA. Again, generally we will not go above 3 or 4. Again, there could be exception in terms of, let's say, infrastructure sector has higher debt to EBITDA, but generally in manufacturing we will restrict ourselves to, let's say, maybe 4:1. Then you have debt to net cash accruals. You know, what a kind of cash accruals it is throwing. That could be another. Then we also look at the resourcefulness of the promoter group, right? Because some of the situations, like ultimately, what are we trying to do? What is private credit trying to do? Why somebody pays you 16, 17%, 15%? And even if these are all good companies, as I talked about corporate governance, capacity, cash flows, collaterals. Why should somebody pay? Because ultimately these are good companies, right? Ultimately, in some shape or form or manner, we are trying to delay or defer the equity infusion by the promoter. So basically, let's say hypothetically, some of the thesis was not to play out. Whether there is resourcefulness with the promoter, whether there is resourcefulness with the group, that again goes into our decision making criteria. And again, last but not the least, as I mentioned, so because some of these situations, like most of the situations would get covered in that, but some of the situations where you are heavy on collateral, and therefore you tend to compromise a bit on the cash flows, because see, if you sometimes you don't get best of all the worlds, right? If you are getting everything very good, then the probably pricing will also kind of fall to that extent. So if you're getting very good collateral, then you try and analyze the collateral, how liquid it is, how marketable it is the valuation that you are going for is a distress valuation, can it be sold on a fire sale basis, how quickly it can be sold. So I think those are the things we look as a fund manager. From an investor perspective, I would say it's a question of his investment philosophy. First of all, what is the investment horizon one is looking at, right? What kind of time frame one is looking at? Are you looking at a 3-year, 4-year, 5-year time frame? Are you looking at 10-year time frame? Are you looking at 20-year time frame? Do you need regular payouts? Are you okay to kind of your money being logged in? Let's say hypothetically, if I talk of let's say private equity as a product compared to private credit. Private credit offers you regular payout. Like we as a strategy offer quarterly distributions. At least 8 to 10% per annum kind of quarterly distribution, and then there's a back-ended redemption premium which takes the net returns to 13-14%. But let's say private equity may offer somebody more, but it does not offer you regular payout. And it may have a longer time horizon. Maybe there the investment horizon is 7 to 10 years as compared to 5 odd years we are talking about here. Second is what is your return risk appetite? Again, as I mentioned in the earlier part, are you okay to looking at a drawdown? Are you okay to, let's say, you are 100 becoming 90? Because nobody can guarantee, right? In some of the asset classes, obviously you run that risk. Thirdly is what is your return expectation? If somebody is, let's say, chasing, I'm just making it up, let's say 20% kind of a return expectation, then clearly that is more of an equity profile, right? If your return expectation, if you're more of a, looking for a capital preservation and at the still same time want to generate inflation beating return, I'm saying then you are again more suited to a debt kind of an investment. So I would say your investment horizon, your risk appetite, your return appetite, and then obviously within the private credit also you have various strategies. So depending upon that, I would say comparatively in a risk return perspective, performing credit would be a little more palatable for an investor who's kind of beginning his journey in the private credit space. Whereas for an investor who's already experienced, understands the nuances, is willing to take that kind of a risk, one can look at things like venture debt, one can look at special seats. So there are various flavors even within private debt that are available, but it's ultimately a investment philosophy of one's own investor that one has to follow.
Yes, sir. And moving on, just to talk about the regulatory perspective, SEBI doesn't always surprises us with new regulation that comes into the AIF side of it. And one of the recent one was like 50% into listed equities, investing in listed equities, and 50% debt securities, and 50% into unlisted debt securities. The main perspective of an investor to coming into AIF is like to have an exposure for unlisted debt securities. But if the same is going to be transferred to 50% to listed debt securities, so how is good? Do you think the how is the space is going to evolve from here?
No, I think there I would like to correct you a bit, Akshara. I think it's actually other way around. So basically, the SEBI always said that primarily it has to be unlisted.
Yeah.
Now they have allowed a little bit of a leeway in listed debt because they are seeing. See, again, now there are two, three regulations which are at play here, which are, I won't say at cross purpose, but which are a little bit of a pulling in different directions, right? So, like on one hand, there is a regulation where by RBI and then SEBI where let's say any listed company has to come up with a listed kind of a debt issuance. Similarly, RBI also wants large corporates to raise a part of their borrowings through kind of listed entities and stuff like that. On another hand, SEBI had this regulation for AI which talked about that primarily, which again the interpretation as fund and people took was that 51% has at least has to be invested in unlisted debt securities. Now, basically, SEBI has just, in fact, it's a discussion paper as of now. It's just an enabling provision that in case of papers rated A and above, 49% you could always go. Now, you could go a little higher in listed debt if it is rated A and below. But again, I would say, actually, listing is one part, right? Again, if I again to take a real market analogy from markets, like you have privately listed REITs also, privately listed InvITs also. So listing is one part. I think listed is more from a I would say trading perspective, but I don't think it changes the very nature of the private credit market as such, where the instruments are much more customized, much more flexible, much more bespoke as compared to the higher rated listed instruments. So when we talk of listed instruments, you know, we talk of let's say GSEC, CP, CD, AAAs, those they have their I would say customs. There are certain customary covenants which are generally you would found in those issuances. Here I'm saying listing unlisted asset doesn't matter because this is much more flexible capital, which is kind of customized to the need of the borrower. Only flexibility that in fact this listing allows is that I don't run foul of any regulation. See, ultimately now if I'm lending into a borrower or an ecosystem, which because of some other SEBI guideline is required to issue only listed NCDs, right? Then basically it gives you that kind of a flexibility. So I would say it's more of a enabling provision which gives the fund manager that flexibility because otherwise in the just to chase unlisted, if you should not be losing some opportunities or leaving some otherwise good deals because again those people also need capital. Just because now someone is forced to issue a listed paper doesn't mean that there will be takers. Like, see, again, who are the takers of listed paper? Banks, NBFCs, and mutual fund. And again, if you look at paper like rated A or below, they won't be taking it. So I think the recent discussion paper is more around enabling or the fund manager is not tripping that guideline of at least holding 51%. So it doesn't change much.
This gave me a different perspective of the consult paper. So thank you for that. And let me take one question from Vishal, is that how do you compare bond market and private credit AUM in upcoming years? Is private credit crowding out the potential of bond markets?
So that's a very good question. I think thanks for asking that. In fact, there I would say, in fact, we did an analysis. If you look at most of the bond issuances, okay, despite being such a comparatively we are a large market, right? And in fact, AAA would constitute a small chunk of that. If you look at, I think more than 95% of the issuances, okay, or round about that, are AAA or rated that kind of a this thing. So bond market as such, when you talk of bond market, is basically the preserve of AAAs or likes about that. So below that, the bond market does not exist. So there's a lot of asymmetry in the bond market. If you look at issues rated AA and below, again, I'm not going to A and below. I'm saying even if you look at issues rated AA and below, which will have a lot of credit demand, there are not many bond issuances. There are not many takers. In fact, even uh, some of those AA papers are advertised heavily. In fact, that's again a much more retail play at work which they are trying to attract. But it also speaks of the fact that had there been takers in the institutional segment in that kind of this thing, they won't need to resort to that kind of advertisements and publicity. So I don't think it is taking away. In fact, only thing what it is doing is it is deepening the bond market. See, because again, any market needs to have different flavors. So it's like somebody says, okay, only Nifty 50 can trade. You need Nifty 500 also. You need a mid cap also. You need small cap also. So same is the case of bond market. So right now, bond market means when people talk of bond market, it's AAA by and large. Maybe some shade of 2-5% AA plus and something around that. And again, if you look at bond market, again, there's a lot of sectoral domination. Who are the large issuances in bond market? NBFCs, would be one of this. Again, NBFCs maybe like PFCs, REs of the world, which are PSU, or it could be private NBFCs also. Beyond that, then you will have in manufacturing, as soon as you go, I think you will have AAA or AA plus. Below that, we are a very shallow market in that sense, bond market. So private credit, I think, is supplementing or filling the vacuums that are not being kind of fulfilled.
And the second question from the same person was like, data scarcity is in Indian companies leads to a lot of opacity and decision paralysis. So how do you approach data availability, and do you utilize any alternative data?
So again, a pretty good question, I would say. So we use a lot of third-party DD where we find there's a data constraint or we want to kind of satisfy ourselves more. So we do financial due diligence. So like we appoint Big Four, your PwC, EY, KPMGs, Deloitte of the world to do financial diligence. We appoint law firm, big law firm to do the legal diligence. Depending on the industry, if it is not an industry, see some of the industries you have done it so many times, you understand it pretty well yourselves or are kind of easier to understand. But let's say when I did my first deal with a amusement park, that was not an industry I kind of readily understood, right? So we had experts flown in fact, from other parts of the world who came in, who assessed the plant and machinery, who assessed the useful life, who assessed the safety parameters. And so therefore we could take a credit call on that. So depending if it's a very kind of a new industry or something which we are not very familiar or comfortable with, we will also have industry experts come and kind of assess the kind of technical economic viability and give us their opinion. And then obviously we also have expert calls which we do to make mind. So our idea is, as far as data is concerned, we are not reliant on the company as such. Only thing we need from the company is more of a cooperation, but otherwise we are pretty much kind of equipped to do our own due diligence without relying too much on the company data.
Okay. And the third question from the same person, I think it is quite different from the question that he asked. The Coal India is providing 7.15% of dividend income. As a retail investor concerned about the retirement coffers and also wealth creation, why should I invest in 8 to 9% yielding notes?
Again, I would take it in two parts. Let me first talk of the equity aspect that he highlighted. So again, see, when something is available at a high dividend yield, again, the price bakes into a lot of things. The price also bakes into the expectation as to the future prospects, future growth. So without again commenting on a stock specifics, maybe people are saying that maybe the growth prospects are not that great. From an ESG perspective, it is something like a negative sector. So again, what you are getting as a dividend yield is for this year, right? Whether that dividend yield, the profits are going to continue or compound at that rate, nobody knows. Whereas debt is a product where you are kind of trying to at least lock in for the near future along with your return of capital. Again, I'm again just making a case here. Let's say if people are thinking like you and let's say 7.1% was with the benchmark. As soon as let's say there was some kind of volatility in the earnings, and let's say 7.1% is the correct parameter of price determination, the price would immediately correct, right? So then you are looking at a drawdown in that scenario, right? So my simple point is again, it's a very different construct. So, as an equity investor, what you are alluding to is a value style, right? A value style of investing. You would always have something where you are getting, if not 7, 5, 6%. But again, my personal experience, I'm not speaking as a fund manager for a private credit here. My personal experience shows that markets, at least equity markets in that sense, by and large, are near perfect, if not perfect. And therefore, price bakes into if somebody is leaving 5% dividend yield on the table, that means there is some issue with respect to the way people are looking at the growth or other opportunities that are available in the market. And therefore, that yield may or may not sustain in the future. That is one point. Secondly, again, when you talk of 8, 9%, it depends. So, like performing credit is a higher return strategy. At least here we are talking about, let's say, 13 odd percent return net of expenses. We have a product which is again higher than this, but still, I'm just to answer your point in terms of if you are looking at any bond product of 9%, 10%. Why do people look for fixed income? So I think since you mentioned dividend yield, you are looking for stability, you are looking for certainty, you are looking for predictability, right? So if you are looking for these three things, that is why you come to a fixed income product, right? You do not come to a fixed income product because you feel the yield is far superior. Obviously, the basic economics tells equity is the residual money. It's the risk money, and debt is a risk off money, right? That equity is laid below debt, right? So equity in that sense logically should have a higher rate of return, right? Higher return expectation, because somebody is kind of layering your debt with his own equity. That person should get some risk premium, right? So the idea is basically what kind of volatility, what kind of a drawdown, what kind of a certainty, what kind of time horizon you have. Again, see, dividend deals may matter from a short term, but again, equity investing, again, then it's a counterintuitive kind of a thing. If you're looking from a long term perspective, you don't know, when you're going to exit. I can talk of many industry. Again, let me give you an example, like entertainment or media as an industry, right? To my mind, since I am a consumer of entertainment, it looks like an evergreen sector. But again, the way investor preferences have shifted from maybe kind of cinemas to kind of OTTs of the world, or kind of a DTH to OTTs of the world, it is having its effect. Your newspapers, like we in finance, we still read papers, but it's kind of decreasing, right? Again, the newer generation, newer people, they are consuming it more on your in the digital format. So I'm saying in equity, price says a lot of things about future growth prospects, about the how the price is going to behave or not going to behave. So equity, even if it is giving you a high yield, has to be evaluated from a different risk return paradigm, has to be evaluated from a different drawdown volatility perspective. Whereas debt has to be evaluated whether you're, first of all, your capital is safe. Are you generating enough return to pay you the risk premium for any risk that you are taking? Are you still able to generate inflation beating return? Again, as I said, that's my personal view. See, equity is more of an excitement product. That's why we have kind of got so much of allure about equity. Otherwise, if you look at, again, as per SEBI data, these days, if you log on to any trading account, I think it says, right, 99% of the traders lose money and stuff like that. So again, equity. So whereas the debt, if you look at debt, you have to really kind of, I would say, horribly go wrong, or not do your homework at all. The kind of time and investment people, time people spend in equity analyzing, if you were to spend, I think, one-tenth the time in debt analyzing, probably you'll end up making much more return or similar kind of a return than equity.
Okay, I think that was a comparison of equity and debt at last from you. And one more question that I had in my mind was like, you spoke about how you crack out deals in Alta. So if let's have an situation, hypothetical situation, probably you got into a deal and it never worked for you, and you had to liquidate it. So if there's any instance that happened in past, if you want to give an example, or how does Arthur see that?
So again, see, in terms of my last few years of experience, so again, prior to, as I said, I was heading our special chain and stress asset platform, where we had two entities, one an AIF and one an ARC company. As part of that, business, along with our JV partners, we did business worth around 13,000 crore. There was zero delinquency, so, and we generated an IRR in excess of 20% per annum. But having said that, again, I started my career way back in 2002. I have had So I think credit, first of all, the basic rule is proactive. You have to be proactive. So proactive not only in terms of monitoring, but also in terms of taking action. So what we do, we appoint, again, we do monitor the cash flows. We have some DD agencies. We have lenders, independent engineers. So like in one or two situations, so I cannot, again, it's a public forum, so I will not take name, but so there was a large steel company. In fact, that steel company also went down, and it was setting up a large power project. Okay, that power project also went down. Okay, so basically we had done a bridge finance kind of a structure, where there were other lenders of the nature of PSU or development financial institution. So the thesis when we went in was that they used to take time. So there is something called as a lending confirmation notice. Okay, so the lead lender would send a lending confirmation notice, and other lenders would kind of disburse. But this process used to take time. So there was a use case. So we came in and we kind of acting as a bridge finance. So when things started going south, right, we saw the project was not kind of moving as per the expectations. We saw early signs of, kind of a cost overrun. And again, we saw some kind of a trouble brewing within the group. So what we did was we pulled in the plug, and, instead of negotiating or trying to give a long rope, so because again, it's a question of who exits first. So again, that is also very important. So what we did, we kind of, we had the checks. So we bounced them. We kind of took recourse under Section 138. We issued notice to independent directors. Basically, what we did, Before it was out in the open because they had not defaulted to anybody as such. It was a proactive kind of an action from our end. We exited. We exited with our principal plus interest. Right. So that is one. Secondly, I can share my experiences as a buyer in ARC company. So I think, see, what you also need to, so it's like a bitter pill. See, sometimes if you have kind of, you know, if something has happened, it has happened. It's water down the drain, right? It's like that kind of stuff. So also you need to recognize that. So some of these things, like again, we have seen paper being traded, like Arcom. I will give an example. So Arcom, like when I think the paper started trading, okay. So as such, we had no skin in the game, neither in either in Arcom any earlier or later. But Arcom, once it started going down, I think initial trades happened at 50, 60 cents to a dollar, and the last trade probably happened at 6 to 7 cents to a dollar. So the way I would look at it is a lender who sold at 50, 60 cents, recognizing that a mistake had been made and they got stuck, was much better off than somebody who waited till the last. And not only they lost time value of money, because again, there was a time gap between the two deals, obviously, probably of maybe more than a year. We are talking about at least a couple of years. So not only they lost time value, but I'm saying even from a recovery percentage perspective, for somebody recovering 50, 60% to somebody recovering 6%, there's a huge gap. So I think the only mantra that one can have in credit is be aware, be vigilant, and be quick to acknowledge and recognize. See, if you close your eyes, it does not mean that it's night, right? It's if it's day, it's day. So you have to call a spade a spade. I think that's the way it is. And now, obviously, as I mentioned, with IBC coming and also value discovery happens fairly quickly. I think once you have realized a mistake, again, see, you could be proactive. So if you feel that as an ecosystem, again, there is money on the table, you are ring fenced, you have good security, you could take quick recourse to IBC or at least threaten quick recourse to IBC. You may get an exit under that. You find other takers. Again, coming from an ARC background, I can say you sell it to an ARC because they are the people who can recover this thing. But for you, it is important to recognize any early warning kind of signals and act on that. I think that is the first and foremost thing.
Okay. And one more question that I had was like, what specific factors put the EPC, trading business, services, and gems and jewelry on your negative list? So
two things, Akshara. So one, if you look at these businesses as such, are not asset heavy. So if I take even engineering, procurement, construction, so you could have JCB, tippers, construction equipment, and stuff like that. But typically, see, this is movable equipment to go, trace, repossess. I think in Indian context, that is next to impossible. Same is the case with services trading. Secondly, these businesses are also people dependent. Team and risk is very high. So generally, where what we have seen is when things go down south. Okay, and let's say you are not on obviously the best of the terms with the promoter or management, or they themselves also may have walked away. Then there's not much you can do, right? Means I'm hypothetically making it up. Let's say if there's an EPC contract being executed by let's say not one of the top-notch guys, right? And or even by the top-notch guys, and but let's say you kind of try and step in, and let's say you appoint hypothetically an LN to complete it. Obviously, it is not going to be margin accretive, right? Because those guys would have undercut or underbid, and if somebody has not won the contract in the first place, so I'm saying it's going to be a loss-leading kind of a philosophy. So you can't do much. And again, in our practical experience, we have seen in the Indian context that these are businesses like again, even if you take off trading, there are a lot of rules and regulation. As a promoter, as an entrepreneur, they have their own way of dealing good, bad, ugly. I don't know, but as professionals, you're suddenly the cost of business starts going up. And again, some of these business don't have any competitive moat or anything which gives you a sustained advantage or EBITDA. It all boils down to the person. If the same person can tomorrow start up another shop. So as I said, net, no asset, people dependent, no competitive mode. So that is, I think, these two, three reasons we like to keep away.
okay, so I'll take one question from Gaurav. I think it's a long question. I think the question is like more like summarizing the whole webinar only. It's like, given the growing interest in debt AIFs in a volatile market, how do you see their role in funding emerging companies compared to traditional equity financing? And the second part of the question, are there innovative structures within debt AIF that we make more attractive for both investors seeking stability and startups looking for growth capital?
So, yeah, pretty layered question. So, let me take the first one. So, see, obviously, in terms of emerging companies, yeah, I think that's a very valid case. But again, it depends on the strategy. So, there are funds who would be looking at or emerging companies or mid-market companies, and there are funds who like to consider, like we focus comparatively, I would say mid to large. We don't prefer small to mid, we prefer mid to large. Again, for us, the reason is that we feel in Indian context the risk premia is not sufficient to move away from the safety of large cap. But having said that, I think yeah, it's a pretty a valid use case, and there are players who are operating in that space. So no doubt about that. And so the some of those situations we do substitute kind of an equity this thing. Secondly, in terms of when again, I think second question also have multiple parts. So see, when you talk of startup, I think it's venture debt funding. That's a very different class in itself. So again, venture debt, I don't have anything for or against it. I'm saying, but the risk reward is a little different, I would say, because see, on one hand, if you use the word startup, on another hand, secondly, you use the word debt, then I would say it suits an investor who's little more aware, little more conscious, who's kind of used to maybe who has some money in the venture capital ecosystem also. Those are products suited more to that investor rather for somebody who's kind of starting his journey, right? Because startup obviously has a different level of risk, and obviously the return is also higher. So, but you need to appreciate that. So each investor has to take a call depending upon that. And sorry, there was another part of the question. I skipped that.
Yeah, the last part of the question was like, did AIF
Structure.
yeah.
So yeah, on the structuring part, see again, yeah. So see, it would really depend upon. See, generally, you could have a win-win situation for both, and that is the thesis, at least in performing credit we have. But it can't be a win-win in terms of pricing. See, ultimately, the pricing is like, see, ultimately so the way we look at it, let's say there's a pie of 100 rupees. Let's say it grows to 150. So it's a win-win. It grows to 200. Let's say it's a win-win. But when it comes to splitting the pie, right? So you could basically provide for flexibility. Like you have structures where pricing, or let's say you charge, as per percentage of the EBITDA, as percentage of the operating profit. You can have, let's say, a base level of a coupon, and then you can say, okay, my final pricing or my final IRR would depend on the this much percentage of EBITDA coming to me. You could have a business valuation case, right? So it could be a win-win from a perspective that, okay, fine, he's not logged into a higher IRR initially, okay, but ultimately I'm saying, yeah, the money has to come from that given pie. So from a structuring perspective, there are all these structures that are prevalent. You could have link it to EBITDA, you can link it to market valuation, link it to any kind of a event happening, any kind of a business sale or any kind of an event happening, any kind of a private placement happening. So you could build all those optionalities in. But only thing is, again, from an investor perspective, if you look at, because again, we tend to look at only the rosy side of things. If I'm, let's say, logging in a 10% kind of a fixed coupon and an optionality which could hypothetically give me another 10%. But in some of those situations, those optionalities may also not play out, right? So from a certainty perspective, I would say, it won't be a zero sum, it won't be the same, but yeah, you could create situations, or you could create deal structures where investor also kind of is looking at a higher payout. Investor is also, borrower is also not kind of bothered or on a higher fixed number upfront, but if he makes money, he can pay higher this thing. That is the only way I think it could be addressed.
Yeah. So with that comes the end of the session, because in this session we have covered almost everything, like from the regulatory changes, about the product, about the asset class, and also about the entry and exit. So for the one last question, I just wanted to get one or two liner from you, is that there are multiple private credit products in this industry now, currently, not like before. So how do you find Aditya Birla, separate or different from other private credit products?
So, Akshara, the way I think we have tried to position ourselves is we are looking at capital preservation as the core of our strategy as of now. In fact, we have also come up with a strategy where we are kind of subordinating our own money. Okay, so we are investing as a sponsor, as a fund in the junior tranche, and investors are, kind of investing in the senior tranche. In fact, that product has been rated CRISIL AA plus SO. Okay, so we are coming up with that, those kind of strategies also. So our idea is basically to kind of grow and deepen this market to offer a higher risk adjusted return. So basically what we are trying to do is we are trying to kind of demystify it we are trying to kind of de-risk the asset class. So obviously we have a performing credit strategy where we are looking at a gross of 15, 16, net of 13, 14. And then we have this AA plus kind of a strategy, which is money manager, where we are looking at a gross of around 11 and a net of around 10. So I think what basically we are trying to do is we are trying to offer an investor a bouquet of options, all kind of revolving around capital preservation as its core, and then obviously depending upon the risk return appetite of the investor and the investment horizon of the investor, one can go for. I think that's what we are trying to do. I think we are doing quite a bit of innovation around that. We are also trying to build in liquidity options in some of the funds. So I think that's what our contribution to this private credit market is, and I think it appeals to a lot of investors, at least that we speak to or we cater to. Capital preservation along with some bit of liquidity. I think that's as good as it gets in the private credit for now in the Indian space.
Yeah. Thank you for that. Gave a holistic view about private credit and the products as well. Thank you for taking time out to educating our investors on how to see market apart from equity as well. So thank you for that, sir.
My pleasure. My pleasure. Thanks.